wanted to just turn it over to Ken at this point. And Ken, why don't you introduce yourself and you can take over. Looking forward to your presentation. Thanks.
All right, let me see if, all right, let me see if this, are you able to see my slides now?
Looks good.
Okay, great. So hi, I'm Ken Frier, and thanks Marty for the kind introduction. I'm a longtime institutional investor, also another guy trying to figure out how to get a haircut. But I'm kind of a scientific or data-driven investor, and what I'm going to talk about today is that, in my view, if the stock market reacted to the global economy in this downturn the way that it has reacted in prior downturns, then stock prices would be much lower than they currently are. I believe the main reason that they're not lower is because of the aggressive and unprecedented policy response, both fiscal and monetary response, in this downturn. The key question for all of us as investors is, will the response be enough to prevent the kind of adjustment to the economic weakness that has always happened in prior recessions? My disclaimer is that what you're about to hear are my opinion and is for information purposes only. So let's see if I can move to the next screen. All right. So obviously, most of us that need to create a good long-term investment result depend upon investments which offer a claim on economic growth. So public equity, private equity, real estate, credit, natural resources, etc. So what happens to those investments when economic growth starts to decline? Well, they tend to lose value because the future income and cash flow from those investments goes down. We have defaults, delinquencies, and bankruptcies. And typically what happens, but isn't happening now, is that there's just a change in risk preferences by investors. In a downturn, investors usually demand a higher return for their capital than they demanded before, and that causes a reset in prices. Economic systems, as Hyman Minsky pointed out, are inherently unstable. A long stable period encourages risk-taking, and the longer the period, the more risk-taking can happen. We had the longest economic expansion in US history just ended, and what was rewarded in that period was higher risk investments. What normally happens in a downturn like this one is, as Warren Buffett says, the tide goes out, you can see who's been swimming naked, and there's just a reset. There's an exposure of speculative investments. There's big changes in the investments industry, prices reset, and then you go up again from there. So as we all know, the slump we're in now is the worst slump since the Great Depression. But at this point, the usual reset in stock prices and cleanup in speculative investments has been avoided or delayed, and in part, as I said, it's because of the unprecedented fiscal and monetary intervention. If you believe in the old rules, which is basically all of history prior to 2010, what you would want to do now is to hedge or de-risk your portfolios and preserve capacity to re-risk at better prices. That if you believe that the rules have changed, there's new rules, don't fight the Fed, then you could count on policymakers to continue to levitate the prices of risky assets until we get out of this slump. So why do stock investors care about slumps? Well, what I show on this chart is in green, the drawdown in the S&P 500 index. It's how much did the S&P 500 index fall in real terms in comparison to the highest price of the prior 3 years. In the pink shaded areas are the periods when the US had recession. There's a strong correspondence between recessions and big drawdowns for equity investors. In fact, there were 7 instances in the last 70 years where the S&P 500 fell more than 25%, and 6 of those were during US recessions. The exception was that crash in October 1987, where there's still debate about how or why did that happen. Every recession on this chart is a smaller, much smaller recession than the one that we're now in. The worst recession until now was the global financial crisis, where the U.S. real GDP fell by 2.8% year over year. This year, the U.S. GDP is expected to fall at least twice as much, so 6% year over year. So it's much more severe, but there's been barely, considering the recovery, there's been barely any impact on stock prices so far. One of the ways that we try to monitor the economy and its relationship to investment assets is at SECOR we created this enormous database of economic data from all the major countries. It has about 350 items in it. We normalize all the data and we make a single calculation of a GDP weighted change in the global economy over the prior year. So the scale here is a standard deviation. So it's that if the green line is above 0, then the global economic data improved in the prior year. If it's below 0, then it got worse. We can observe that the periods where global economic data declined by a lot in a hurry tended to coincide with the periods where the US had a recession, which are these pink shaded areas. We also can see that the economic data is lagged. A lot of the data I'm looking at is from March or April, but even with the data that I have, we already have a larger correction now than the previous record correction, which was in the global financial crisis. You just see the descent of the green line on the right-hand side of this chart. Looking at the global economy another way, I'm going to focus on the chart in the upper right on this page. What this chart shows is, in green, the expectation for global real GDP output that was based on the Bloomberg projection as of December 2009, so before the virus crisis. And then the black line shows what the current Bloomberg consensus for global real GDP is. There's a lot of excitement that we could be reaching the trough, that the global economy might start recovering soon. What is lost in that, I believe, is the fact that even if the global economy starts recovering now, that there's a multi-year period in which the amount of global output is going to be lower than what was previously forecasted. And if you're thinking as an equity investor, companies have operating leverage. So 6% decline in GDP could be a 25, 30, 40% decline in earnings. So we need to look at how not just 2020, but all the years ahead will have lower earnings for corporations than what would have been reasonably assumed in December. And I don't believe, if looking at what stock prices are doing, I don't believe that that calculation is reflected in stock prices at this point in time.
Hey, Ken, a couple of questions before you leave that.
Oh, sure.
So one thing is, I think there's definitely a political environment where nobody wants to correct the stock market because of the pension liability. So I think that's a big thing, that there's tremendous pension liability, and if the stock market corrects with so many pension funds having heavy stock portfolios, that becomes an issue. And then the second issue is, you're talking about reduction in earnings, but I mean, it seems to me there might be some inflation coming down the pike as well, and maybe earnings adjusted when inflation happens might be a little bit higher, or am I wrong? I mean, help me out.
Well, that's yeah. So both of those things are I think relevant points when we assess what's happening now. I think I could be wrong about this, but I think there's a reluctance among the money center banks to be too vocal about the challenges for the stock market, because the money center banks might depend in this cycle on largesse from the government, and so they don't want to get on the wrong side of the government. I think this the kind of contrast between the stock market outlooks I get from independent asset management firms versus the ones I'm getting from money center banks. With respect to inflation, that's really an important debate. I don't think that we're likely to have inflation now because of the slump in demand, but we also know that in economic history, if you read a book like This Time is Different by Rogoff and Reinhardt, you can see that many countries in economic history have managed to create inflation for themselves by doing the kinds of things that are being done around the world now, of creating new money, buying real assets with the new money, and having hefty deficit spending. So I have some recommendations toward the end of this, and one of my recommendations is to develop a real asset strategy in case that the inflation genie gets out of the bottle. So on this page, the green line is the same green line that I showed you, which is the amount that the global economy changed in the prior year. I added to this a blue line, which is the amount that stock prices changed in the last year. It's the trend of global equities. I'm taking the current price of global equities, dividing it by the prior year average. What I find compelling about this chart is that the cycles are in alignment. You can see that when the global economic data moves, it moves from getting worse to getting better, that the stock market tends to turn at the same time. The magnitudes also tend to align. That is, if the amount the global economy improves or worsens is bigger or smaller, the adjustment in the stock market is bigger or smaller. It certainly makes sense because the weather that global economies live in is the global stock companies live in is the global economy, and so they can't operate at a different temperature than the temperature of the economy. What I find astonishing and in the last 3 months is what's in the dashed oval on the right-hand side of this chart. The green line shows the descent of global economic data, and the blue line shows what the stock market has done. There has never been in the history that I have a bigger disconnect between the economic change and the, I think someone needs to mute. There's never been a bigger disconnect between the economy and the stock market than what we have, at least what we had a few days ago. These disconnects always resolve, so we need to think as investors about how it might resolve. One way for it to resolve would be for stock prices to fall substantially, 40% or more drop in stock prices. Another way for it to resolve, which may be what stock investors are betting on, is that green line just shoots right back up. So the pre-virus economy is recovered very quickly. What I think is the safest bet is that those lines meet somewhere in the middle. Yes, the economy will recover, but it'll probably be slower and more gradual than people have hoped, as the Fed indicated in the remarks of yesterday. And then the stock market will come down to meet it. That would be my bet, but we're all guessing here because this is such an uncertain time.
So you made another comment where you said that overall you can't have, when the overall temperature is a certain amount in the economy, when things are negative, you can't have you can't be percolating as a business. But one of the things I'm wondering about is this, so if you look at the trend in globalization, which is negative, is it possible for there to be a negative trend that's great in global trade, but not necessarily as negative for the U.S.? And again, part of the fallacy of my assumption is that the U.S. has so many global companies, so they're naturally going to be hurt by a downturn in trade. But maybe you can talk about that some.
Yeah, I think one of the other things that I believe is being lost with respect to hoping that the pre-virus economy comes back quickly is the pre-virus economy is gone for good. That economy, we're not going to see that economy again. A lot of the jobs that have been lost are in, say, in leisure, hospitality, travel, et cetera. Those jobs aren't coming back. And you're talking about global trade, that this virus has also revealed vulnerabilities in these globally extended supply chains. So I expect there'll need to be quite a lot of restructuring in the labor force, the kind of jobs that people have, and also in supply chains. I think the global companies in the U.S. are more concerned about exposure to sourcing their products as much outside the U.S. as much as they do. And so this restructuring of the labor force and global supply chains is another thing that would would slow down the economy to some degree, in my view. So moving to this page, if I'm again using the trend in the global economy and the trend in stock prices as my flags for deciding what to do as an equity investor. In the period before 2010, if the price trend was negative and the economic trend was negative, then it was on average a bad time to be an equity investor. On average, if you look at the I don't know if you guys can see the little hand, but if you look at this box in light blue, you can see that for price negative and economy negative, the average return on stocks was 6.5% below cash. Those periods, I'm going back to the prior page, those are the periods where both of these lines, both the blue line and the green line, are below zero. The rest of the time, owning stocks was rewarded. On average, the return for owning stocks was more than 5% higher than cash. So you could have had an easy roll 25% of the time when prices are trending down and the global economy is trending down, don't own stocks, and the other 75% of the time own stocks. And you would have done a lot better than if you'd owned stocks all the time. However, in the last 10 years, those rules have been turned on their heads. In the gray shaded area, you can see that the best time to own stocks has been when the price trend has been negative and the economic trend has been negative. And I believe the reason for that, well, I'll talk about that on the next page. I believe the reason for that is that as soon as that starts to happen, we've had very significant policy responses and public statements that have caused the stock market to turn around sharply. What I've done on this page in the chart is I've color-coded the last 52 years based upon the economic trend and the equity price trend. The parts of history that are shaded red are those double negative periods where the economy was getting worse and stock prices were trending down. And the green periods are double positive periods. You can see the thick black line is the return of global equities net of cash. You can see clearly that the periods in which stocks did badly, that is the black line descending, tended to coincide with these red periods of double negatives, which also tended to coincide with times that the US was in recession. However, if we look, and of course the green periods, the double positive periods, are typically quite good periods for equity investors. You can see a steady march upward of equity prices in most of the green periods on this chart. Now, if we look at the last 10 years, there's been multiple short red periods where there was a policy response. In 2001 to 2011 to 2012, that was turned around by the famous Mario Draghi, the European Central Bank chairman, that did do whatever it takes to solve the European problems. His stock started booming from there. In the 2015 slump, there was a big policy response, primarily from China. I think China bailed the world out of that one. Then in the 2018 to 2019, the Fed, which had tightened in mid-December, dramatically turned around in early January last year, saying that not only are they not going to tighten anymore, but they're going to stop quantitative tightening, and that led to the boom. So every time the stock and the economy looked negative, there's been this big policy response, and of course the policy response now is the biggest ever seen in history. The debt to GDP for the developed world is going to now exceed the prior peak, which was during World War II. So, and this just shows that there's also been shifts in the behavior of other asset classes in this period, where the double negative periods, the cavalry has come in and returns have been good. You see, not only have stocks done well in the last decade, when it looked like things were about to go bad, but real estate's done well, high yield has done well.
Ken, you've got about 10 more minutes left.
Oh, okay, yeah, I've only got a handful of slides.
Oh, great, perfect.
Left. There's almost certainly a trade-off between protecting current prices of risky assets and their future returns. Yes, the Fed may be able to create new money and levitate stock prices, but they can't get rid of the economic consequences of the downturn. Instead, what they can do if they levitate stock prices is they can cause us to have meager returns on risky assets in the years ahead. What this chart shows is a kind of simple way of calculating the attractiveness of being a U.S. investor who would own a 60% stock portfolio and a 40% bond portfolio. This is the blended yield using the Shiller Cape yield, so the reciprocal of the Shiller 10-year price earnings ratio as 60% of this calculation, and the 10-year treasury yield as 40% of this calculation. That blended yield at the end of May was 2.4%. That's the lowest blended yield of the prior century. So it indicates that we're set up, if stock prices don't fall, we're set up to get quite poor returns. If the price to earnings ratio for this simple 2-asset portfolio went back to 4%, that is, if the yield got back to 4%, the change in portfolio value would be a 40% loss. So even a small change in this blended yield would cause a big loss to investors. I believe it is possible that the Fed could continue to support asset prices, as Marty, as you pointed out, that could lead, that certainly does elevate inflation risk, although it's not clear whether it will lead to inflation or not. But I believe if we continue to have elevated stock prices, we don't have elevated earnings, and so we're not going to be able to enjoy the kind of historical returns for stocks that we once would have had. Another factor why this recovery won't be as speedy as people hope, or I don't think will be as speedy, is financial conditions. Many economists regard the credit cycle as being the fundamental process that drives the business cycle. And if credit tightens, that is, banks become less willing to lend, then that means that it's harder for the economy to take off. What I have in the chart at the top of this page is our composite of financial conditions in the average of the last 7 US recessions, going from 12 months before the recession started to 12 months after it started. And that's the blue line. The red line here are financial conditions in the current cycle. We can see, if you look at the 0 point, we can see financial conditions were about historically average when this pandemic crisis began. But now, 4 months into the recession, financial conditions are actually worse than the average for the prior 7 recessions, and they're on their way down to get even worse. So I think, Marty, you mentioned credit investing. I definitely would recommend people to have a strategy for that. Usually the best results for credit investors are when financial conditions reach their worst state and start to get better. And I don't believe we reached that worst state yet. The other...
Ken, just to interrupt for 2 seconds, I was on the phone this morning with a firm out of Europe that is offering a credit marketplace purely for distressed assets. So distressed, all these credit vehicles that are being defaulted on, they'll end up in a marketplace somewhere, and people are going to buy and sell them.
Yes, yeah, once or twice a decade, there's fantastic opportunities to invest in credit. So, so good investors should be poised to take advantage of those. One of the things that equity investors should recognize is that earnings are going down a lot and are going to take a while to recover. The chart here shows quarterly earnings for global equities, the All Country World Index, starting at the beginning of 2018 and going through the estimate for at the end of 2021. The earnings for equity in Q1 of this year were $3.93. That was almost half of a 50% decline from the year earlier Q1, even though in many countries the virus impact was concentrated to just the last weeks of the quarter. The other bars show the Bloomberg estimates for the later quarters. All in all, this shows a 24% decline in earnings year over year, 2020 versus 2019, and we only get back to the 2018 earnings in 2021. So in essence, we go 3 years with no earnings growth for global equities. Historically, if earnings have fallen year over year, the stock market also falls. But that's not what's been happening. In fact, the stock market had a 23% return from the end of December 2019 through.
And we have a couple of minutes left, but do you think this is because of interest rates or, concerted Fed efforts or what?
You mean the elevated stock price or these
Correct. Yeah, the
declines in
elevated
earnings?
stock price. Yes.
Well, I think it's because of the policy response, because of the additional liquidity injected in the market, and because there seems to be optimism among equity investors that the virus will be over soon, that the economy will recover soon, and so we'll see if that's if that is merited. This is the last slide I have. I mean, this is the most uncertain time in my career to make investment decisions. We don't know what will happen with the health consequences of the virus. We don't know. The policy intervention has never been at this scale. We don't know what the effectiveness of it will be or the consequences it will be. We know that a lot of individuals and businesses under stress, that tends to flow through in unpredictable ways. We don't know that. And there's a big shift underway. We can't recreate or just turn on the old economy because behavior has changed. And so all of that is very hard. It's beyond my capacity to figure out. One option, the option that's worked for investors so far, is to just count on policymakers to support markets and to stay invested. The other option, which hasn't been helpful since March, more helpful today, is to emphasize safety. As I said in this chart, as I suggested, I think asset prices for equities and other risk assets offer limited upside from here. If equity prices aligned with the global economy in the way they always had historically, they would fall a lot from here. And also fiscal and monetary intervention without triggering inflation is a limited resource. And it can't get people on planes or to go to ball games or crowded bars. I mean, the root cause of the economic decline is social distancing. As long as some people will want to social distance or will change their behavior as the virus is out there, then the economy is below its prior state, and we're in this deep crunch. So that no amount of money being being injected in the economy can ease the pain of individuals and businesses, but it can't stop the fact that there's this big slump in activity. If you're an investor who prefers a safe option, and we at SECOR are recommending the safe option to many of our clients, is you should reduce risk. We think it's better to hedge and preserve upside, but if you don't have the capacity to hedge, you could just reduce your holdings of risk assets because the return from here might not be very good.
And so it could be a great time to be like hedging or investing in hard assets, or?
Well, I think that it's definitely something that you should look at. You might have some time though. I think it's unlikely that there's going to be like inflation right away. I mean, given the demand shock here, which is going to get worse when the unemployment benefits run out or get reduced at the end of July for U.S. The demand shock is going to be even worse. So it'd be hard for inflation to become a big problem when there's this demand issue. But longer term, if you create, the Fed indicated yesterday they're willing to continue to create money at a rapid pace, and typically, if at some point, if you create so much new money, the value of the old money goes down, and you have an inflation problem. So I definitely would look at real assets as part of a portfolio strategy to be ready in case that does indeed start to be a problem.
So I've got about one more minute here, but
okay.
My last question is, any thoughts on the global dollar supply shortage? Because I mean, I think that's pretty relevant given kind of a global macro perspective you have, right? Because I mean, it's not just a matter of the Fed is printing dollars for Americans; it's printing dollars for a lot of other people, right?
I think so, but that's not an issue that I've studied, Marty. So I don't think I can give you an informed response on that one.
Gotcha. Okay, great. Well, Kent, listen, thanks so much. It's a great presentation.